Hello, I've been given the OK sign. That means we are live. Let's give it a bit of let's give it a few seconds, guys. Let people come in. I mean, if you are here right now, right on time, thank you so much for joining us. So let's just give it a moment. And I want to get this on my phone as well so I can read chat, see what you guys are saying. Unfortunately, my phone is not working with me today, so it's okay. We'll read chat off screen, so that's fine. Anyway, if you're here early, welcome back to In Your Best Interest Malaysia, the live show where we talk about things live.
And we're still on.
We are still live. We're still happening.
And this
every
episode
month.
is a review of the first half.
Yes.
And it's also called I Told You So.
Oh, well, we'll see why he says that.
Okay.
Oh.
We got a instruction to restart,
Yeah.
so we'll rewind ourselves.
Yeah. Let's rewind. Now you get to watch us introduce ourselves 2 times. Okay.
We're professionals, guys.
Oh yeah, don't worry. That's why it's not on my.
Yeah, maybe it was just not live. It was just not running. It's a real painting.
Wow. Eh?
Real painting.
I thought yeah,
Which I saw yesterday. That was pretty cool.
Where? In the museum?
In a gallery. People are exploring the inner feelings and
It's in Malaysia lah.
yeah,
Set in Malaysia. So cool.
pretty cool, right? Look at the detail, pretty good. Then on the blur in the background, pretty cool.
Yeah, that blur is so realistic.
Very real, right?
The
this
Shell
view, yeah,
station.
amazing. It's
The cup chai.
cup chai there. It's damn good.
What is it? What is it?
Ready?
Yeah. Oh, hello.
We're
I believe we are live this time.
Okay.
So thank you all for joining us. Give us a few moments to let everyone else come in. But if you are here on time right now, welcome. We're so glad to have you here. So let me just see if I can get this on my phone, and I would love to read you guys, saying hi in chat. And I have it right here. So if you want to ask any questions, as always, please feel free. We are watching it. I'm watching it right now. And also, if you're watching us from YouTube, I believe you're on YouTube as well, you can chat there, and we will watch for chat there as well. Okay, so let's get things started. Welcome back, everyone, to our live show In Your Best Interest Malaysia.
We're still here.
We are still here.
They can't get rid of us.
they can't. Every month we'll be here. So we're so glad to have you again. If it's your first time here, let me introduce myself. My name is Imran. I am I wrote it here, Ken. I describe myself as a financial translator.
Oh. Okay.
But I'm the writer. I'm a financial writer here. StashAway, Ken.
I'm the country manager of Malaysia. Looking forward to today's show.
Yeah, because today's show we have a big one, or rather, we try to summarize what is a big half of the year, for whatever has happened in the first half of 2025, and a lot has happened. Ken, I think.
Too much.
So some may say too much.
It's a retrospective of the first 6 months that have come and gone.
Yes, it's a retrospective, the biggest events, and yeah, it's anything but boring. I think it's too exciting sometimes.
Also known as the I Told You So episode.
Yeah, so can't call
There
it
were
that.
a few predictions the investments team made earlier in the year, which came true, some in ways that we could not have predicted, but nonetheless very interesting. So we'll go through them all.
Yeah, we'll go through them because, as Ken is alluding to, some of the things we talked about throughout the year, right? Some of the articles that we've written and the videos that we have produced. Also, more importantly, we will also be covering how our portfolios have performed in the first half of 2025, right? So we'll get into the real numbers, right? Not just talking about the events. Okay, so let's get into it with our first segment, Invested. And yeah, we'll just go with a retrospective for this show. And I think for me, to sum up what's happened for the first half of 2025, it's really three big macroeconomic drivers, right? And here at StashAway, we came up with an acronym for it. We call it FAT. And F stands for fiscal policy, A stands for AI, and T stands for Trump.
Yeah. Can't avoid.
You can't avoid Trump.
Yeah.
He's everywhere, President Trump. And when I said, I think the A and the T are quite obvious, but when I say fiscal policy, I mean sort of the shifts that we are seeing in some governments around the world, the big ones, and I'm talking about big government spending. So if you see in Europe, we see that they've really, like for example, Germany, they took off their debt limit and they are, spending more, especially when you start to take into account factors like tariffs, right? I think tariffs is another big topic to talk about. Maybe the T should stand for tariffs.
The T should be FATT. Trump,
FATT.
Yeah, they can share the T because Trump caused the tariffs. And tariffs were caused by Trump, right? So
yeah, so you have tariffs, and when you talk about tariffs, you start to talk about economic drivers like inflation and interest rates, right? Okay, but let's focus on tariffs specifically. I think one of the bigger events was in April with Liberation Day, or President Trump's so-called Liberation Day. That's when it was announced these like really broad, really wide-ranging global tariffs that the US wants to charge on these countries, right? And when I think one thing we have a video on this where Ken, have you heard of this term taco?
yeah,
Yep.
Trump always chickens out.
Yeah. So that's sort of the narrative that we are seeing right now also. It's where the US makes these big threats, right, with tariffs, for example, and then pulls back a little bit. So for an investor, what do you see in the markets, right? You see a sharp drop. And then when the threats are pulled back, markets recover. So I think that is a brief summary of everything that's happened in the first half of 2025. Ken, what do you think of all of this happening?
Yeah. I mean, there's also conflicts, right? We saw Iran and Israel trade missiles, and the US actually coming in to basically try and put an end to their nuclear program. How effective it was, we don't know, but that was also a flashpoint. But essentially, yes, you're right. Is before Liberation Day and after Liberation Day. But I think what was really evident was that after Liberation Day, we started to see cracks in what we've been calling US exceptionalism, right? Then there has been this increase in risk premium to invest in the US economy because there's a risk that the economy would not grow as fast, or a recession would occur because of these tariffs. Inflation would rise because of these tariffs, and rates would not come down.
I mean, we are still seeing it play out right now.
Yes, exactly. It's still
so it's ongoing.
Too soon to say whether we're out of the woods. And I would say regardless of that, even if you're positioned in a very US-centric way, you would have still come out ahead. The S&P is up 8.86%. And considering how much volatility that has been, you passively just investing in the S&P would have still done okay, right? It's just that US has underperformed compared to world equities ex-US, which is up 17%. Gold is up 24%.
Because you see where investors rotate away, like capital must flow somewhere, right?
Yeah, certain indices in Europe and in Asia, like the Hang Seng, have done better than the US, for example. But I think the big thing here, which we'll address later on as well, is that the US dollar has slid, right? If you look at,
that's the other big one.
If you look at USD versus ringgit, USD has weakened about 5-6% year to date. And we'll talk more about that later on.
Yeah, because that really can affect your portfolio's returns, right? If you are diversified globally.
Exactly.
Okay, I think for me, to sum up this segment, it's really, there will always be headlines. There will always be headlines. Maybe, arguably, maybe right now we're in a period of increased frequency of headlines. Maybe some people may say that. But I think the point is, when you talk about long-term investing, I know I may sound like a broken record, but it's really the point, and where you want to look at it in the long term. regardless. So this is a good example, right? This is a very good example, the first half of 2025. If you had reacted to any of the short-term headlines, of which there are many, you would probably have underperformed simply staying invested.
Yep.
Right? Probably, very likely, unless you really pinpointed every single point in time, right? And for the general person, including myself and many others, the general best strategy is just to stay invested. You know, as
we do sound like a broken record, and I did say, you know, we told you so, but like after Liberation Day, we said keep calm.
Yes.
And literally the next week, we saw a really big recovery, some of the biggest 1 day, 2 day moves in the history of the S&P.
Yes.
And up to now, we are still not just up on the year, but back to all-time highs.
Yes.
Not just in S&P and the Nasdaq, but gold and Bitcoin. So there seems to be a lot of worry, a lot of volatility that comes with investing, but somehow markets are performing.
Yes.
So I think you need to look at the results and also all the noise and decide for yourself what kind of investor do you want to be. Do you want to be very impulsive, or do you want to be disciplined and stay the course? And no one said that discipline is easy, right? And we'll look at returns later on as well.
Yeah, and that's our very next segment. So for our next segment, we'll be talking about portfolio returns, but I do want to address some of you guys in chat. So we have Vian Thun, hello. And because I saw this comment, and from Fua Dalias, they asked, where is the office located?
Oh.
I don't think
In KL.
in KL.
Actually, if you Google StashAway Malaysia, you will see we're a
It's a publicly
We're a
known
B2C company, and we have an app, and we serve the general public. So if you Google StashAway Malaysia, you'll see where it is.
Well,
right.
there you
So,
go.
so in the beautiful, hazy KL.
Yeah, it's quite hazy, huh? I think
So is the investment outlook. Actually.
amazing.
Very, very hazy.
What a segue. So, our next segment is, I think I call it Performance Monthly. So let's talk about performance.
Okay.
Let's look at some real numbers. And I'll be just focusing on our general investing portfolios. So for our general investing portfolios, and these numbers will be for H1 2025 or the full first half of 2025. For our general investing portfolios in the lowest risk portfolio, i.e. 6.5% SRI, it saw 5.4% returns in USD terms. And on the other end of the spectrum, with 36% SRI, you see 10.8% returns in USD terms, for an average of 9.3%, which is pretty good. With everything going on, right? 9.3% returns if you had stayed invested for the full first half of 2025.
Pretty good.
And you know, setting aside returns, I think one of the important things I wanted to bring up when talking about portfolio numbers as well is how they deal with risk, because returns is one side of the coin, and then you have risk on the other side, right? So let me give you a very interesting number. The most aggressive portfolio, SRI 36%, which simply means that it has a greater weightage to equities. The peak drawdown, that means how far your portfolio's value dropped in the period, was 13% in April. So April's Liberation Day sell-off, right? The worst day.
So what was first half returns in US dollar terms?
So for SRI, 36% was 10.8%.
So basically, to get 10.8%, you would have to, I'll say again, to deserve this 10.8% returns in the first half, you would have had to endure a 13% drop. 13% drop, yes. Which is not for the faint-hearted.
Yes.
So this 10.8% doesn't come with its harrowing moments and its moments of peril. So you really need to think twice before investing in a high-risk portfolio. But
that's a great way to put it.
That's why I'm here.
Yeah.
You're welcome.
That was really great. He brought out my point. So
I read the production notes and I saw your talking points.
No, I didn't have it here. So, and then on the other side of the spectrum, 6.5% SRI, or the most conservative portfolio, it saw a maximum drawdown of 1.5%.
Very stable. Very stable.
So it's working as intended, right? Aggressive and conservative. So it's really up to you, your choice, right?
Yeah.
And I think the last thing I'll say here is gold has been a big performer as well for our portfolios. If you are very in tune with our portfolios, you'll know that we are quite overweight on gold. Our investment team is. And gold alone as an asset class has contributed 0.8 to 2.6 percentage points in total to our portfolios, depending on risk.
Yep.
So that was a quick rundown on the numbers. Ken, do you have something to say about our portfolio numbers?
Yes.
You want to add on?
So this is report card time, right?
Yeah,
and you know when you have a good report card, or you know whether you have a mediocre one, and it's not nice to have something other than a really amazing report card. I think we report in ringgit. So because we report in ringgit, the US dollar returns is only half of the story. At the end of the day, we still need to acknowledge the fact that we report in ringgit and people invest in ringgit, and when they withdraw, it's also in ringgit. So ringgit returns are more real to us Malaysians, right? And from a ringgit perspective, the range just now when
I
you
was saying
spoke about
5.4 to
5.4 to 10.8. In ringgit terms, the range is between flat returns, so about 0 to 4.3. So very underwhelming if you look at it from just an absolute returns number, right? 4.3, not very inspiring returns, but mostly those that's attributed to the US dollar, right? So US dollar weakening post Liberation Day was a very real factor in eroding your returns, and the US dollar fell 5% year to date and 9% in the span of 12 months. So I will say that with FX returns, if you tuned into our webinar not so long ago about why FX returns matter, sometimes they add to your returns, sometimes they take away from your returns. We just happen to be in a period now where the US dollar is broadly declining against most currencies, right? And that has not been the case if you look at the last 10, 15, even 20 years of how strong the US dollar has been. But having said that, like we keep reiterating, you are investing globally. There is FX risk embedded in these portfolios, and they can add to your returns and they can take away, but you still should focus on the underlying asset.
Yes.
When we did the webinar about 2 weeks ago, we highlighted the fact that even though the US dollar and ringgit pair is very volatile, 5 years later, we are pretty much where we are now, 4.25, 5 years ago. But in the meantime, the S&P has gone up close to 100, even 100% in the last 5 years. So, and that's without FX returns. So the underlying asset is still very healthy, and it's something that you should be taking into account when you invest. Another thing we talked about is the difference between denomination and exposure. Denomination is just what the price of something is. If let's say you have the Japanese stock exchange listed in an ETF in the US, it's priced in US dollars, but it takes into account the yen relationship with the US and also the performance of all the Japanese companies operating within the Japanese economy within that ETF that's listed in the US. So that's denomination. Exposure is what is the actual asset that you are, for lack of a better word, exposed to, which takes into account the real exposure. So for example, you wanted to cite some of the S&P companies, right?
I have a few examples. So, I mean, if you think about it, I could list a number of examples, right? I think most large multinational companies nowadays, it's a very globalized economy, right? But I'll give a few examples. So, for example, Microsoft has upwards of or more than 50%. They make more than 50% of their revenues overseas, globally, right? So they are a US company, yes, but where are they making their business, right? Where are they making their profits and their revenues? More than 50%? globally, right? And Apple as well, and I could go on and on and on, Nvidia as well. So, but the point is, when you invest in these companies, even though they are US companies or USD denominated ETFs, for example, but they could be Japanese companies, right? With a Japanese ETF, they could be operating in multiple markets all over the world, right? So that is what you're investing in, right? So that's something very important to keep in mind as well. When you talk about USD weakening against the ringgit. Lah.
But of course, we also should share with people what banks and economists think of where the dollar will be. So we looked at Bloomberg, and basically by 2026, economists and banks have formed some sort of a consensus. We are about 4.25 right now, and on the high end, some banks think that will be about 4.4, so an appreciation of about 4%. Some think that it could go down to 3.95, so a decline of another 6%. So the range is relatively tight. I would say the window is relatively small in terms of the range of where these banks think that the ringgit will move compared to the USD. So I think that it's not looking like it could fall a lot more, but also you shouldn't really factor in like big ringgit weakness or big US dollar strength moving forward. I think the banks and economists are thinking it will move in this
that range,
plus 4 minus 6 range, right? We don't know exactly where it's going to go, but for right now, this is what we're seeing. So currencies also tend to fluctuate, tend to revert to an average or to a mean. It goes in cycles. Like we said, some years it gives you extra performance. Some years it takes away. So you have to factor in different kind of risks when you're investing globally.
Yes.
So, and in that sense as well, we keep talking about it, but diversification matters. When you look at your StashAway portfolio, the actual exposure to USD is around 52%. So let's just say half. The rest is other currencies. Or different kind of exposure to different countries, right? Emerging markets, parts of Asia, Europe. So it's not just a USD exposure.
Yes. And to take it to the extreme level, even if you were just purely investing in the S&P 500, all American companies, my point earlier is that they make money all around the world, right? Okay, so let's move on to our final segment, Real Talk. So Real Talk is a segment where I go around Malaysian subreddit, and also we do get client questions, and we try to answer them live. So for this round, I'm sort of summarizing a number of client questions that we have received, and it's all about interest rates, right? So you can see around the world, for example, in the ECB, right? For the ECB, European Central Bank, they've cut rates to around 2%. Bank of England is cutting as well, and a number of central banks all around the world. So what does this mean in general? In general, it means you start to see some bond yields falling, and the question is, how does this affect our clients? Short-term bonds, long-term bonds, and their cash investments, with all the yields falling. I mean, that's the concern here.
Yeah, I think when you look at central bank rates, that's a really big determinant to how asset prices perform. Interest rates coming down, broadly speaking, should be positive for bonds, should be positive for equities, less so for cash, and less so for bond yields. For bond yields and cash returns, those two things compress or become less. So it's broadly positive for bonds and for equities, mostly because what you're signaling here is that money becomes cheaper, borrowing becomes cheaper. You can raise more money through the credit markets by issuing more bonds at a cheaper rate, so companies can invest in growth. And because of that, there's less friction or less drag when companies raise money, so that they can look at growth in terms of expanding their factories, issuing more products, things like that. It's broadly a kind of a good thing.
Yeah.
And that's why Trump is also urging Jerome Powell to also cut rates. It's just that Jerome Powell is balancing inflation at the
Yes.
same time. It's a very delicate balance.
And when
So
you factor in tariffs as well.
yeah,
when they
all of those
start to
things. It's a
see-
very predictive kind of thing. You can't really say that
Yeah.
cutting rates will definitely be good for America long term, right? That's why there's some resistance to cutting too quickly. But I think as an investor,
Yeah.
it comes down to what your goals are. And of course, you have to recognize the effect that rates will rise and fall and the impact it will have on your investments. But it doesn't mean you change your investment outlook, or it doesn't mean you change your goals. You wanted to talk about short, medium, and long-term goals.
Yeah, because
and how this may actually affect it, but you don't actually change your
yeah,
point of view.
I mean, the point I wanted to make, we do talk about the show beforehand, right? And I wanted to bring up the point where, sure, you can talk about interest rates and yields, etc., etc. But for me, the greater point to be made here is how you look at the tools that are available to you. Okay, so what do I mean by this? When you have cash management tools, short-term bonds and money market funds, things like that, right? Those are for your very short-term goals. Those are for your emergency funds, right? Whether or not the rates fall, yields change, etc., those are external. They are external to your plans and your goals. You will still need an emergency fund, right? You will still need to purchase that home in a few years' time, right? That doesn't change. So you should focus on that aspect of things. What else can give you that long-term growth? Stocks, right? So if you look at it, at each of these asset classes as tools, as options in your greater portfolio, then all of this is just short-term, right? Sure, you can change your plans a little bit here and there as interest rates rise or yields fall, but that doesn't change the fundamentals, right? So I think that's the point I wanted to make there.
Yeah, don't get fixated on these predictions or data that may not directly impact you immediately.
Yeah.
Because equity markets also tend to have expectations of when rates fall.
Yeah.
So some of it may already be factored in.
Yes.
So its actual rate falls or hikes in and of itself may affect equity markets very little. It's more the expectations and the speed of how these cuts are implemented, if at all. So I think it's a very valid point, right? You should understand how it affects your portfolio, but stay focused on your goals, whether it's short, medium, or long term.
Yeah. I think that's about it, Ken. That's all I wanted
Let's
to say.
leave it there.
Yeah.
A lot can happen in 1 month, so we'll see you a month from now.
Yeah. I hope not too much happens.
Maybe one big thing at a time.
Yeah,
right?
one big thing at a time. Sometimes it gets a bit too much as well. Speaking as a person who has to write about it every week, right?
But our time is up.
Yes, but our time is up. So thank you all for joining us.